and gentlemen, analysts and associates, welcome to your Managing Director Secretary's favorite podcast, the Big Swinging Decks Podcast by Litquidity and Moran. This is not financial advice. You'd be a bottom bucket analyst to make investment decisions based on what is discussed on this show.
Welcome back to another edition of Big Swinging Decks. Lit, how the hell are you today?
I'm doing great, Mark. I'm doing great. There's so much going on out there, and I'm just, trying to get through everything and staffing Carl.
Carl, he fucked up the newsletter recently, a few weeks ago, but, his performance has been better. I will say that.
Yep.
I will say that. But, with us today, we have a very special guest. We have the co-CEO and co-founder of Titan, Clay Gardner. And we get a super insightful interview. Sometimes we're not the most insightful people there are in the world, but this is going to be pretty insightful about his experience, his thoughts on taking risk, his whole belief in the company of Titan and what they are doing in their path of democratizing finance. And before we start this awesome interview with Clay, if you're not watching on YouTube, then make sure to check this portion out because he does give us a very brief tour of the office, which actually is the old Hinge office. So, Lit, should we take it away?
Let's do it.
Awesome. Let's do it.
Well, Clay, welcome to the show. Lovely to finally get you on, and would love to get to know the story and share it with the shareholders.
Absolutely. Thanks for having me. Excited to be here.
For sure. So as we said in the intro, we want to do a little bit of, getting to know the journey from, you starting at Goldman Sachs as a summer analyst to now founding Titan. Could you give us a little, to make it like a traditional, finance interview, how'd you get started and how'd you get to where you are now?
Yeah, I'll start with how I got interested in investing because that kind of guided everything up to this point. Started trading stocks when I was 12. Parents let me open a Fidelity account, put some chore money in there. Made a bunch of money in the 2000s riding a bull market wave. Lost a bunch of money in 2008 when I had just started undergrad at Penn. And I was like, screw this. Like, I have no idea what I'm doing. I want to learn the ropes. And so I got a couple internships when I was at Penn. So I studied finance and comp sci as an undergrad. Thought I wanted to be a quant trader, actually. That was why I studied computer science.
That's what you grew up wanting to be, a quant trader?
Well, no, so I lost a bunch of money in the mid 2000s, and I was like, there's got to be a formula. I was like, there's got to be a scientific solution to this. So I was like, I'll figure out how to program my way, to riches, to like stock market gains, and quickly realized, competing with the Get-Go's and Rentechs of the world was a losing proposition. I was like 10th in my high school, like in math club, right? Meanwhile, I'm going to school with international math Olympiad, champion. So quickly realized I wasn't going to be a professional quant trader, but I studied computer science because it was interesting. I'm a pretty analytical person. I love numbers and stuff. But anyways, after I wrote off quant trading, I was always been interested in investing, and like I said, I started doing that when I was a kid. So I got a couple of internships. I think it was sophomore, junior year at Penn, at Goldman. I started in the funds business, which is really it's called GSAM, and it's not a very in the weeds investing role. It was more just I understood how a bunch of different hedge fund managers and allocators thought and invested. And then the next summer, I joined formerly the Principal Strategy Group, which is now called Goldman Sachs Investment Partners, and that was their multi-strat prop hedge fund, and that was sick. That was an amazing experience. I was looking at I'm trying to think. I was looking at potential frauds in China, like the Sino-Forest of the world. I was looking at all these interesting credit situations, and I was 21 years old. So it was living and breathing the stuff I read about in the history books from the financial crisis. So it was a great experience. I got the bug. I was like, I definitely want to be a investor, like a proprietary buy side investor. But I had never had the banking experience. So after I graduated Penn, and I didn't want to go the traditional bank route. Like we all know, the 20 hour,
can't blame you for that weeks.
Yeah. So I was like, how do I fast track this path to the buy side, but also know how to walk through capital structure, like know how to build a 3-statement model, be able to like hold my own versus my peers who are like, my co-founder Joe is like top of his class at Goldman Industrials, IBD. So I decided to go to Cerberus. This is a distressed PE firm. It's actually a pretty awesome role because it was like right when PE firms and hedge funds started recruiting out of undergrad. Now I think it's like a pretty well trodden motion. They have like OCR, like campus recruiting processes, but this was not pretty novel in like 2012. If there was like 1 or 2 like new grads who got an offer to work at like Bridgewater. Or
that's how I remember it. I was like, holy shit, like everyone wants that direct from undergrad, and it was just one person. It was always someone from Penn or Harvard. So I guess you have firsthand experience from that. So curious how that went. So like, was that from the internship at Goldman in their principal trading group or investing group rather, and then you parlayed that to Cerberus? Did you have any sort of distressed like experience when you were there?
I had literally zero.
Okay.
It was like, I was all over the map, right? Because I was like, I want to be a quant trader, but I'm also doing some quality investing of my own, and I was like, all this interesting multi-strat stuff at Goldman. I think they were just impressed because I had, if you've graduated Penn, namely like the M&T program, which I graduated from, which is like dual degree award in engineering, and you got a couple of summers at Goldman, you're probably not idiot, was I guess their logic. And there was also a couple people that they had tried out undergrad recruiting from out of that program at Penn and had a lot of great things to say. So there was one guy a couple years older than me from the same program at Penn. It was like the first undergrad that they had hired at Cerberus, who was like an absolute all-star. So I think they were a little bit like, let's keep this good thing going. I clicked pretty well with a couple of VPs and MDs that I chatted with, and I went through the typical super day process, right? I mean, this was like, man, I'm getting like glimpses back into how like took the train 8 a.m. on a Friday up to New York. They put you in a room for 6 hours, like literally a conference room waiting, and then you come in and do like your 2-hour live modeling test, and then like 2 hours of like rapid fire questions. I think I also had like a bunch of these like brain teasers and stuff. So I guess I passed. But no, it was 90% horsepower, because if you think about, I don't know if you've heard of stories of the Cerberuses of the world, like the Apollos, it's like 90% stamina, and obviously like attention to detail, getting the numbers right, like not screwing, making glaring errors is like table stakes. But it's mostly like stamina, horsepower, and then some ability to like think creatively and be able to present and pitch things to like an MD or a VP. So it was a great experience there, I would say, and I spent time both in PE. Like I was like flying down to like Abilene, Texas, like flying into Dallas, drive 4 hours to the middle of nowhere to like, we were rolling up O&G services companies, like fracking, like drilling, like wireline, like all these super, like I learned more about oil field services than I ever thought I would in a year and a half there. Yeah. And then also doing some interesting stuff on the credit side, because Cerberus is a big MBS, a big like residential mortgage-backed security business. It's actually one of the most profitable businesses. So I spent a little bit of time in credit there. So like that was an amazing team. If you put that side by side with like a typical investment banking experience, like yes, I worked like 110, 120 hour weeks, and it was super grueling. It was part of the reason I ultimately wanted a different next chapter. But what an amazing experience, man! Like 22 years old, like flying across the country,
it's like jack of all trades. I mean, CMBS, oil and gas, everything, and doing it from a buy-side perspective at 21, 22 years old is something you don't really get, especially like if you're say industrials, for example, just to the lightly jab Joe. It's like you're focusing on one industry, maybe just M&A or some IPO type work, but sounds pretty cool, man.
So it was I would say it was probably differing philosophies on like, do you be a specialist or you be like a generalist, right? Like I clearly went the generalist route. Like by the time I was 24, I had spent time in hedge fund of funds, direct like multi-strategy hedge fund, private, like distressed, right? Like quality. Like I had spent time doing a little bit of a lot of things. Versus spending 2 years. There's probably different schools of thought on what's better. For me, it was definitely the generalist. So like my takeaway was like, get as much experience across the life cycle of investing, privates, publics, different types of asset classes across the capital structure. in doing that, you'll have the accounting and like technical proficiency to work pretty much anywhere. And hopefully you figure out where across that life cycle you're happiest. Because that was ultimately what informed my next decision, which was to hop to Farallon, like move from New York to San Francisco to like the opposite for some, which was like quality investing. Like Cerberus is like buy things for 3 times EBITDA, pick up cigar butts, do a dividend recap 6 months in and then find the next private equity buyer, right?
Yep.
So Farallon was the exact opposite, which is like, how do we own things for 30 years across real estate, across credit, across equities? So for me, the reason I did that, one was I wanted a little bit of like a lifestyle change. Just like, I never lived in California. That was pretty surfing, skiing on the same day on a Saturday seemed pretty fun to me. But also, I wanted to lean into the quality investing side of things, which was like, how do I take a private equity approach to public markets? Buy amazing businesses that can do all the work for me and let time arbitrage, like let duration work for me, versus the opposite, which is like buy this thing for cents on the dollar, milk it as fast as possible, and find the next person at the table to sell it to before it blows up.
It sounds more like investing rather than trading, which I think that's kind of like what I liked personally about private equity, where it's like you understand the fundamentals of the business more so than just like, hey, like we're gonna do this real quick, flip it, and like not give a fuck about like what that business is, in 2 months. So very interesting, and it sounds like taking that jack of all trades approach and really applying it to, literally like now doing private equity, like thinking cap on. So I guess like so you spent a couple years there, and then what was sort of the light bulb that went off in your head that said, hey, I need to leave this and start Titan?
So I'd spent 2 years at Farallon. I was in the Bay Area. I got a lot of reps with public, like long, short public equity. So that was Farallon. I had an opportunity to come back to New York I met a girl, classic. I met a girl. She had an opportunity to come back to New York or move to New York for the first time. I had an opportunity to come back. Most of my friends, social network, et cetera, is in New York. So it was right place, right time, right opportunity. So Blackstone had started this platform called Synfina, which is basically a multi-manager platform, not different than how the Citadels and Millennials are set up. You can think about these as pods, and there's 10 pods. So I had an opportunity to join one of these pods as like the third hire. So there's former PMs and a senior analyst from 3G Capital and Balyasny. And the thesis was, $1 billion plus of gross AUM, of gross assets. I was going to be in charge of running half of that in TMT equities, and the other 2 partners were going to focus on consumer, so like soft lines, hard lines, food and beverage, etc. It's like, oh, that's a pretty sick gig. Like coming back to New York, having all of the resources of a firm that large, from a data standpoint, from a corporate access, management access standpoint, as well as having $500 million of capital to deploy into a really concentrated strategy, by the way. It was like 10 to 20 longs and maybe 15 to 20 shorts. This is really concentrated for what typical pods run. That's a separate story, which then will inform what the next chapter. But that was the first quote like entrepreneurial endeavor. And the plan was always like we were going to scale up this fund and then perhaps spin out and raise outside capital. So if you're putting yourself in my shoes, you're what was I at the point? 26? You're 26 years old in New York, super small team, running $1 billion of capital, backed by one of the largest, institutional managers in the world, with a specific slice that I own in TMT equities, focused on quality, compounding businesses, being able to do longs and shorts, and then ultimately have a path to maybe go out and be a $5-10 billion fund, raising outside non-Blackstone LP capital. So like that was of which I would help create like the pitch deck, go actually run the roadshow, chat with Cap Intro and various potential LPs. So that was the plan. I would say a few months in, Blackstone, I think, and I don't want to speak for Blackstone, but my perception was that I think the risk model didn't totally jive, right? Which is like running super concentrated long short equity and then also using a good healthy amount of leverage, right? And having really tight risk limits the math doesn't really work. Like on a day where Netflix is down 30% today, right? Like, on a day where Amazon is down 5-10%, if you have a double-digit percentage position in Amazon, you may get the tap on the shoulder that day. Like, you're gone. It's crazy. Yeah. But like, it sounded great in theory, like run a Buffett-style concentrated portfolio, but also be able to have more assets to deploy by virtue of using leverage. But something's got to give. And so that realization was ultimately how the platform, pretty quickly after I joined, wound down a bit. The pod or the team I was on stuck around. But for me, it was sort of like a good moment of reflection. I was like, okay, I came back to New York. I have some savings at this point, because remember, I'm like 5-6 years into working on the buy side. So I have some savings. I live pretty cheaply. I was like, I came here to start this entrepreneurial thing. I love investing, but I want to start something more entrepreneurial. And I had never been an operator. I'd never worked at a tech startup. I never built anything from scratch. I've just sort of joined existing ideas and theses and hopefully added some value.
Guy. Yeah.
I was a finance guy. And I think I was pretty intellectually honest. I was like, dude, what the hell is a finance guy now? So I literally, I took some time off from that role, as did my co-founder. We literally made a list of like 55 ideas, like the stupidest ideas, some of which were actually pretty good and are now massive businesses. But ideas like, we went around talking to like local like nail salons and like barber shops, thinking like, oh, maybe we want to start like a back end vertical SaaS company to like, run barber shop like appointment and like payments. That's also same with like yoga studios. By the way, those are now like huge businesses, and we would have gotten clobbered had we started them, because we have zero expertise. All the way to like shop and shops. Like, we were like, you guys have been in these buildings, like the JP Morgans, the UBS, like these massive buildings up in Midtown with just huge empty lobbies. It's like, what the hell are these, like super expensive square footage, and it's just a massive vacant lobby. We were like, shop and shop. Like, we'll create a platform, like a two-sided marketplace, where vendors, not like, halal vendors, but like, I don't know, premium luxury vendors can have set up almost like kiosks, like shops in shop, effectively letting the landlords or like the banks earn, income off of that vacant real estate, if you will, and letting, vendors access some, pretty marquee foot traffic for a fraction of the cost of like mid to long-term leases. So like, great idea, but again, super smart finance guy thesis, zero inside baseball sort of access or expertise. So thankfully, we did not pursue any of those. We instead, we were looking inward. We were like, what are we the best in the world at? Or what do we think we're best in the world at in our domain?
And so Clay, when you say we, you're talking about your co-founder, Joe, right?
Co-founder Joe, yeah.
Talk to us a little bit about him, how you guys met. At this point, you're just trying to come up with business ideas. You said he was Goldman Industrials, but tell us a little bit about him.
Yeah, met Joe when we were 18, first day of school at Penn. So he was at a dual degree program, a little bit different than mine, but I would describe us as like, when other classmates were at like fraternity, sorority mixers, because, there's a big Greek scene at Penn. Joe, I, and maybe 5 other friends of ours were in Huntsman in like a GSR, which is like one of these like conference rooms at 4 a.m. like cranking on like problem sets. No joke. There's probably 10 people, and by the way, they're all wildly successful. Like literally managing, like a few folks I know managing like $5 billion hedge funds as 30-year-olds. So like it's funny going back. It's almost like the whole, what does Buffett say? Like, if you trace like all the great investors back to like they all took that same class with Ben Graham, or like that same Stanford Business School class in like the 70s. This was sort of like all attributable. If you went through Huntsman Hall at 4 a.m. on like a Saturday, Joe was there and a few other friends. So that's how I met Joe and got to know him. We had no idea we would start something together, because he went to Goldman, like you mentioned, banking for a few years. Then he was in the Bay Area at McKinsey, working with fintech companies like Visa, PayPal. And then he came back to New York. Pretty crazy, like literally same time I came back to New York, he happened to come back to New York. He also wanted to scratch an entrepreneurial itch and join a startup fund. He had never worked a day in his life in the investing business, but got a job at like $100 million, one guy, mostly his own capital, was a super successful PM, started a long short fund. So pretty crazy, like both back in New York, both at these like pretty early stage long short equity funds. And then both pretty quickly realized this was not going to be the best long-term place for us. So again, right place, right time. Both had a little bit of savings, so decided to take some time off. And that's when we spent a few months just like spitballing and like walking around Manhattan with like our notes app open on our phone, just like, like shooting the shit on startup ideas. How we ultimately landed on Titan, though, was like Joe and I looked at ourselves and we were like, what's the biggest problem that we have faced ourselves that we think we're uniquely good at solving? And it was like, well, ever since undergrad, I was basically the one managing my own money, like self-directing my own portfolio. I've frankly been doing that since I was 12. Joe was the opposite. Like Joe was like top of his class at Goldman Industrials Banking, didn't know which like SPX ETF to pick. And so it was like, I was basically doing this for like, call it 50 friends and family, like sending them a Google sheet. It's like, okay, here's at least how I'm positioned personally, across, individual stocks, maybe like some special situation stuff, ETFs and so forth. So I was effectively like on the side, not for money. I wasn't making any money on it, but was advising friends and family. I was like, holy shit. A lot of people have the problem of, I wish I had a smart friend who worked on Wall Street who could do this for me. And I think we all probably know, either we are that person or we know someone in our circle. And Joe likes to joke, like when he goes back for like high school, his like high school Thanksgiving, like annual reunion, like everyone asks him for stock advice. Not even because he's like a good investor, because he works in New York at this company called Goldman Sachs. And he was like, everyone just assumes I'm the finance guy. I was like, holy crap.
This is a most super classic meme. Yeah.
Totally. So I was like, man, if we could find a way to, I think the word democratize is thrown out way too much, but scale. If we found a way to scale me, not that I'm some special individual, but a way to scale expert active management to those who otherwise, because frankly, like there's a lot of people in America who are not like Joe. Like they didn't go to school with a Clay or XYZ. So they're going to either YOLO, day trade, and Robinhood themselves, or maybe they go to a passive low-cost robo-advisor, or somewhere in the middle. But there's probably a massive wedge in white space for people who want an active money manager, can't afford one, can't find one. That was how Titan was born.
And so at this point in time, it's 2017-ish. So this is before the rise of Wall Street bets, before we're throwing around the word democratization. This is just really, you're throwing it into a vanguard. That's it.
Yep.
This whole thing about Joe being in Goldman Industrials and not knowing what ETF to pick, I was kind of in that same boat, honestly, because like when you're in banking, you're so restricted in what you can invest from like your personal account, and it's like, I mean, what do I know most? Oh, like industrials. If I'm in industrials, or like for me, I was in TMT, so I'm like, oh well, I love TMT. I want to invest in TMT, but I can't because you're restricted from that, and so I was like, what do? I just threw it in S&P. So I totally think that's, something a lot of people don't realize, from investment banking. Like, you're not really picking stocks for a living. You're doing more fundamental work. So definitely see the need of something like this.
Yeah, you bring up a good point, which is, we could probably talk about, which is we didn't really create Titan with a thesis of like, we call like the complianced out individuals, which is anyone who works in like banking, management consulting, you work at one of the big four auditors, you cannot own single stocks. There are specific compliance rules that are like, good luck, dude. Like you can invest in like 5 mutual funds or these ETFs. So we were amazed because we just stumbled upon this massive market of like complianced out folks who literally can't invest. Even if they're like, I know exactly what I want to pick, they literally can't express that because they can't self-direct. So Titan is different in that Titan, you come to our platform, we're a managed account. Like we're fully discretionary. So you can invest with Titan while you work at, Goldman Sachs, Tiger Global, wherever, and you can actually get direct exposure to whether it's like Google or Amazon or what have you, managed by us, of course. But yeah, that is just a side note.
So going back to 2017, when you guys are seeing this opportunity in the market, how do you start off? What's the first product, and how do you grow that into your current offerings now?
So first product is called Flagship. You can think about Flagship as, what would an active manager create as a better version of the S&P 500? Well, I can tell you a few very quick principles. One, more concentrated, because I don't think the 500 largest U.S. companies is a good reflection of like where incremental returns on capital are going to come from. It's probably more like the top 30, 50. We chose 20. After 20 securities, you look at the math, like the benefits of diversification start to drop off dramatically, and you actually start to dilute the upside from any of your winners, i.e. the slugging percentage. So we said, okay, 20 to 25 equities, quality businesses instead of crappy businesses. So those defined as like growing, not shrinking from a secular trend standpoint. Hopefully margins are expanding instead of contracting. Those not too much leverage on them, run by decent management teams with skin in the game, like reasonable prices. TLDR, like the Buffett approach, was the initial. It was like, what does Clay know best? Like how has he at least perceived like money management should operate? during his time at Farallon, and more recently the fund he joined prior to Titan. And so that was Flagship. That still exists today in pretty much all of its original forms. So 4 years later. So that's Flagship. Notice, like, the key principle there was get a product to market as fast, as cheaply for clients as possible in like the domain I understood best as an investor, and really vet the whole, because this whole thing was a hypothesis. Like, the whole hypothesis of Titan was retail investors, like millennials, Gen Z, will want to invest with active managers. That was the most contrarian thing in fintech 5 years ago. Everyone was, literally, we got told no from 110 VCs, and I can go on the list: Sequoia, Benchmark, Andreessen, by the way, who's now a Series B investor for us. Boom, 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 boom. 30 more times than Robinhood got rejected at the seed. The key reason being, dude, this market doesn't exist. There's do-it-yourself, self-directed, of which Robinhood, now you have Public and others, E-Trade, Schwab, etc. And then you have do it for me. You have Wealthfront Betterment, new age, UX on top of very ancient products, which is the Vanguard, BlackRock, et cetera, ETFs. It's like, no, there's a huge middle ground, and they just didn't buy it because there was no proof. You could say that we, in some sense, created the market, but in reality, the market had existed for 40 years. It's just the mutual fund market. I don't know how many of us get excited about mutual funds. I own 0 mutual funds. So it wasn't that the human behavior went away. Our parents likely still own most of their retirement in mutual funds, which, by the way, are run mostly by active managers. It was just the UX. It was indirect to consumer. There's middlemen that charges all sorts of fees. There's lots of share classes. If you pull up Fidelity, you'll see how ancient the UX is. So it was like, no. It doesn't that the market doesn't exist. The right problem, the right solution hasn't risen to solve a problem for a market that does exist. It just hasn't basically been passed on from an older generation to ours. So that was the thesis. So how we had to basically validate that hypothesis was correct using our own capital, and like literally my grandmother's capital, and like my parents, and like the friend from high school who I was like, he did me I did him a favor at one point. So I was like, hey, could you give me $5,000? That was how Titan got SEC approval, like paid ourselves New York minimum wage, had a WeWork on Broadway in Soho to get the first $1 million of AUM. And then we got into Y Combinator, and then everything changed. But it was just like the consensus stupid idea. It's funny nowadays, people are like, oh, fintech's so crowded. It was like, they were telling us that back then, when there were no active investment management apps. So yeah, it was and still is like the most contrarian thesis I've heard in this space.
That's crazy though. Like, just saying, getting denied by hundreds of VCs, and so that was all prior to Y Combinator then. And I'm assuming, like, once you went through the whole Y Combinator, program, or rather, I don't know what to call it because I'm not a tech person first either, but like, was that the moment where, oh shit, like, Titan's a YC alum, like we should fund them? Or like, how, when did that kind of pivot from denials from VCs to, all right, you're getting now the major VCs on your cap table?
It's funny you mentioned YC because YC also rejected us twice before we got in. We rejected us in spring of 2017, fall 2017. So it was truly like, I remember this vividly because we were in a WeWork, we had a whiteboard behind us, and we were like, dude, we have $20K in the bank. And this is with paying ourselves minimum wage because we have to pay our broker dealer to like keep the lights on, to like execute trades. This is not cheap. We had no scale, so we had no economies of scale or operating leverage. So we literally drew like 3 columns. It was like an A, B, C. It's like choose your own adventure. It's like path A, shut this whole thing down, return capital to our investors, take a massive ego gut punch, and move on to whatever the next thing was. Path 2 was keep the capital but pivot. We have no idea what we're going to pivot to, but just try to make this last $20,000 work, and hopefully it's not a total zero. Path 3. Apply to this thing called YC one more time, because what the heck? Like, we already have our old application. Fortunately, now we have some data. So what we didn't have the first 2 times was any product in market, any SEC approval, and any user or AUM growth to prove that anyone wanted this product. And if you know YC, and they call it like an accelerator, but YC's mantra is make something people want. So if you're not making something people want, or you have strong, like, either a background as a serial entrepreneur who has a track record of building what people want, or you don't have the data to back it up, like, they're basically taking you at your word, and you can be like a snake oil salesman. So I respect the fact that they pushed us, come back to us in 6 months with an actual product. Fortunately, with that $20K left in the bank, we already had a product just gotten into market in February 2018. So like, what the hell? Let's just pitch one more time. And then of course, like once we had the data looked really good. Like we were growing like weed organically every week, something like 20-30% week over week, just like insane, like petri dish type growth. They were like, okay, we should probably give these guys a shot. These guys are true cockroaches, won't go away. Little did they know we were like 4 weeks from going away, or God knows what would have happened. But that was the story. So YC changed in the sense that like we were in a house in Palo Alto for 3 months. You show up to weekly, they call it group office hours. So like you show up every week and you basically report to your coach. You're like, hey coach, here's my score from this week. Here's our user growth. Here's our revenue growth. Here's the problems or bugs that we've had to fix. Here's the open-ended issues. Here's the opportunities. The coach was like, okay, you suck at this. This is shit. Do this better. This is great. Good job. And then you come back every week. So imagine like you're in boring Palo Alto, nothing else to do, like no girlfriends, or your SOs are across the country. Like I got 2 guys from Wharton and 1 guy from Stanford. He's like in top of his class at Stanford comp sci. Like, of course, we literally grinded like 10x harder, 10x faster than anyone else. And we ultimately, Paul Graham told us, the founder of YC, told us the day of demo day, he was like, you guys know you're number 1 in the batch. I was like, what do you mean number 1? He was like, yeah, we have an internal tracker. You guys are number 1 out of 9,000 plus companies that applied.
Wow.
I was like, holy crap. I was like, why? We could only chalk it up to like, we did exactly what we said we were going to do. Like in a world of like, you guys know, like Silicon Valley founders, like promising the world, like, oh, we're profitable. Like I was watching WeWork, that WeWork show last night. And there was the episode. It was like, why did you tell people you're profitable when you weren't? Like we operated from a place of like insane cynicism because we had been rejected so much. So we were like, we're not going to lose this 120K that YC gave us. We're not going to let 3 months go to waste. We're sitting around twiddling our thumbs anyway. There's no social life. So like, we're going to get after it. And in a world where like, we're also 28 at the time, right? There's a lot of like these founders who are like 18, 20, 22. Like they're still quote unquote finding themselves. Like they're still figuring out what they want to do. For us, this was like life or death. This is like, if we screw this up, who knows what's next?
So were you like the boomers of the batch?
It's funny because I would say we were probably like the middle, like the mode. There were actually some true boomers. There were some guys who crushed it. There was a guy who created a rocket company that SPAC'd for $1 billion, I think literally a year after YC. That was like one of the OG SPACs of this like era.
Damn, yeah.
There's a few others. Several other great companies, Modern Treasury. Those were like our closest friends in the batch. Those guys are a $2 billion company backed by Benchmark and others. So there was like 3 to 5 companies in there that we really admired that I think are going to be like multi-decacorn public businesses. But I would say, it goes back to like what learnings could I apply from like my days in finance? There's no substitute for horsepower. And I'm not saying like the whole work-life balance thing is BS or people need to like should be grinding for grinding's sake. But like I can't attribute our success to anything else other than a crap ton of luck, and like we would not go away. Like nothing phased us at that point. And then after we graduated YC, like it didn't get any easier, by the way. Like our broker dealer got acquired by Square, became Cash App. We had COVID, which like destroyed markets. We had several big corrections. So like it hasn't gotten any easier, but like, man, do we roll with the punches after having that early experience.
So you guys go from having your back against the wall, really almost thinking about shutting down, to now you're kind of coming out of YC with your heads held high, being number 1 in the batch. What do you do when you get back to New York? How do you start to scale? And how does your role and how does Joe's role kind of change? Because at the time, it's just you two, right? And then presumably you have this path to success now right in front of you. What do you do?
So fall of 2018, we raised a couple $1 million the seed round. We had some great people in there in that round. All the partners from YC, Box Group, like the David Tisch is VC, a bunch of awesome partners. But Paul Graham, founder of YC, there's literally a poster in the hall of like the YC auditorium, which shows like this. It's almost like, that chart that shows like euphoria, then like depression, denial, whatever. That like psychological chart.
Yeah.
He has an amended version of that, which is like you have like TechCrunch launch, and then you have the trough of sorrow. And what he means by that is like you go to demo day, YC or TechCrunch always has this. It's like September, October. They always have this article, which is like, here's every company that pitched at demo day, with like links to the company's website. So every company in the batch usually gets like a pop the day of demo day. It's like, oh, you get the TechCrunch coverage. He calls it like the TechCrunch, like, peak of hope. And then you get the trough of sorrow, which is like the world moves on. It's like, great, dude. No one cares about your crappy little 2-person garage startup. It's like, let's move on to the next news story. And so you have this trough of sorrow where it's like, yeah, it was truly a one-time bump. Now get back to building and making something people actually want. So that was it was true to a T. So after the TechCrunch article, whatever, it was like, growth was still solid, but it was like, back to normal. Just like shipping stuff, building. It was just me, Max, and Joe at that point. Max is our CTO, co-founder. We brought on one of his friends from his previous startups, who's one of our best engineers, who's amazing, who's still here today. But that was it. 2019 rolled around. We were super frugal. We had not spent really any money on marketing. That was another thing PG taught us from YC, which is like, treat every dollar like your last. We were very allergic to spending money. Having had our $20,000 left, it was like, we're making this last forever. So 2019 rolled around. 2019 is like the lost year for Titan. The reason is 2019 rolls around, the broker dealer, if you know like how fintech stack works, you have someone who's making decisions, picking stocks, bonds, whatever, which is the RIA, Registered Investment Advisor. Then you have a broker dealer. This is, you think of like the prime brokers, like at all the big banks. This is like the order flow layer, right? This is like matching buyers and sellers and taking spread. That part of our business, which we rented, so we were the RIA, we rented everything below. You can like the custodian is like the AWS of the industry. We rented that. We're not gonna like set up our own server farms. So we rented that. We also rented the buy-sell layer, the brokerage layer. That layer got pulled out from underneath Titan because Jack Dorsey at Square was like, I'm launching Cash App investing. How do I buy that layer as opposed to having to go seek FINRA approval for a year? So there's a classic buy versus build. So Jack was like, I'm just gonna buy this thing called third-party trade, which is Titan's BD, ripped out from under us. So we had 6 months where basically 100% of our 2-person engineering team had to fix what effectively is like heart surgery. It's like take like a coffee shop and rip out the Square terminal. It's like, dude, how do you make money? Like, how do you accept payment? Like, build this now. Like, forget marketing. Forget like getting more customers. Frankly, I would like to turn them away or say, please wait a moment while we fix. We will do heart surgery. So that was 2019 for us. No front end product work, all back end edge work. 2020 rolled around. Fortunately, it was another blessing in disguise. Call it like luck. We had not hired anyone, so we had a super, super thin payroll. All paid ourselves still like nearly New York City minimum wage. When COVID rolled around, March 2020, man, were we prepared. Like immediately while others were playing defense, we went offense. At that point, everyone else, like we had fully fixed that brokerage issue. We got back to building front end stuff. If you remember, like markets were up, down 5-7% a day. Clients, our customers, it would take several days for them to get money in and out of Titan just because of the ACH system. So we built instant deposits. We built that in like a few days.
Interesting.
Immediately drove user delight, right? It's like, okay, instead of investing in Flagship, because I don't know, if I invest now, I may buy it when it's up 10% in 2 days. Now they can get that capital deployed in Titan Flagship in like a matter of minutes.
And at this point, you're only having the Flagship offering?
Only Flagship.
Gotcha.
Only Flagship, yeah. So COVID happened. Flagship obviously fell. It fell less than the S&P, peak to trough, which was good. So we had less than 100% downside capture and more than 100% upside capture coming out of it. But for us, like the highlight of 2020, silver lining was obviously a really shit year for a lot of people, for pretty much all of us. But the silver lining was, dude, tell me about it. So I mean, the silver lining for us was fortunately there was, as a business, we had minimal overhead. So we actually got cash flow positive, like literally not like community adjusted EBITDA, like literally the cash balance went up in the bank midsummer 2020. As a result, we started now deploying that to be more aggressive with go-to-market, like marketing. We made a couple more hires. So as the markets bounced, yes, obviously Flagship bounced, but also our product velocity started compounding. So naturally the investor community finally woke up. And if you were asked around like who are the fastest growing fintech companies or like the best managed fintech companies, I think Titan started coming up in conversations because we started getting inbounds unsolicited for the first time in our history of people wanting to give us money. And this is a classic, like the best analogy I give is dating. This is classic, like the girls want to go out with you when you don't, when you have a girlfriend, right?
Yeah.
It's you're most sought after when you're least available. Funny how that works.
Well, that's like the Seinfeld episode, if you guys have seen it, where Costanza is like pretending to be engaged and everyone's like interested in talking to him. So
Totally.
Yeah. Yeah. All my
So that was
references
like-
right now are Seinfeld, by the way. So
That's funny. So, like summer, fall rolled around and we started getting interest in the Series A. We didn't need the money. Again, we were profitable, but it was like, okay, finally, man, having a budget to like do marketing, to hire Joe literally taught himself design. Joe designed our entire app for the first 2 years. This guy was like he was literally busy building Goldman McKinsey decks. And like I joke with him, this is like the one time in his life this remains useful to this day. The guy, if you ever in need of like a startup deck, like a pitch deck, man, like to the extent this Titan thing doesn't work out, Joe's going to be on Upwork or TopToll renting himself out for startup decks because the guy is an amazing designer. So he literally designed the app, but that did not scale. So we're like, man, it would be great to have some capital to have an actual true designer. So so we raised our Series A in the fall, led by General Catalyst. I think it was $12.5 million. And that was finally like sigh of relief. Finally some, not like play money even, just like money to like right the wrongs of our tech debt. And Joe designed the app and Clay making every single investment decision. So, fast forward to, even spring, summer of 2021, we had an investment team, management team, people from the buy side and sell side. We had a legit design team, a product team. So then it just snowballed. So I was like 2018 was like finally someone in the world sees the light, and that was YC Titan. 2019 lost year. It was like, oh, you had one little moment of an up, here's a big down. It was a classic startup journey. 2020 was man, aren't we glad we came into this so small, so lean. 2021 was like fuel on the fire. So we went from basically having not raised a round in several years to we raised the Series A in late 2020. Series B was preempted by Andreessen. We're not, and then to this day we're still getting interest from investors despite not needing the capital. So
which
it's
is
just
awesome. It kind of reminds me of
awesome.
like Sylvester Stallone when he was like he had to sell his dog a few days before he sold the script for Rocky, and then look at what happens with that. So you have your backs against the wall, and then it's just been full force since. And so talk to us a little bit about where you guys are right now. How many employees? What's your location? Looks pretty nice back there. It may have been the former headquarters of a dating app, huh? Is that true?
And
this is for
balloon.
Nice.
Here's the little. I'll give you the sneak peek. Yeah, this is our Greenwich Village HQ. We got the bird's nest up top, which is where our investment management team sits. We got the pit down below. You can see some balloons. This is actually the 5-year anniversary today from incorporating Titan. So that's some people
nice.
brought us
congrats.
brought us some balloons in. Yeah.
Nice. So 420.
Yeah, we have a 420.
Yeah, was that intentional to incorporate?
It was not. It was not
420.
intentional. What's funny about funny dates is our flagship, our business was incepted, like literally launched in the App Store on 220. So we had like a 2 and 20. Like the 2 and 20 fees. We had like we had like several like promotions or quips around that.
That was intentional.
Yeah, that was definitely intentional. We have 100. I want to say 105, 110 employees today.
Okay.
We have, we are in the former Hinge, OkCupid, IEC dating app family headquarters. So that they moved up to Midtown, I think. So this will fit. I would say we're probably 3/4 New York center of gravity. People in Brooklyn, Astoria, where have you. A lot of people come into the office, but we're very flexible. Like we don't have an in-office requirement. Our whole exec team comes in. So like our VP of Eng, VP product. I think that's important. And then the rest are remote, man. They're all over Florida, Denver, a bunch in the Bay Area, Seattle, a few international. So that was one great thing about COVID is, dude, like the video technology, like all the bells and whistles, like talk about a pull forward. I don't love Zoom as a stock because I think a lot of that is true pull forward, but I love what it's done for us as a business. It's like we can go anywhere, we can find better talent, in some cases cheaper talent, and so forth. So New York center of gravity. We're here in Greenwich Village. For a former, finance, founding team that's now in fintech, I think this is the least corporate place on earth. So if anyone's interested in working at Titan, strongly incentivize you to come by the office and check it out. This is it was a very deliberate decision because I used to work at the famous like Citadel building up in Midtown, and I was like, I want to design the opposite of that for Titan because I think a lot of what we're doing is very I won't say anti-Wall Street, but there's a lot of like rebellious DNA and energy in what we're doing, as you can tell from my history.
Yeah, and what I was gonna say though is, when speaking of new hires, how do you draw talent over to a startup from a traditional financial industry that pays so much?
It's a good question because we only started doing it a year ago. Now we have a 6-person investment team. We have 3 folks on the IR team who used to be, and they're like, they have, they're 763 licenses. They used to be at like large RIAs. It's basically folks that, not dissimilar from my background, we're like, I know like the playbook to either like talk to like wealth management clients if they're in like a PWM role, or like build a 3-statement model, like how to like chat with IR teams, like how to engage and like leverage corporate access. Like it's basically, they feel like they know the playbook, they know the building blocks, but it's like they could sit here and like basically wait it out because there's usually folks above them. And like, basically a lot of my story. So like talk to anyone on our investment team. It's like, yeah, I could totally be a PM on XYZ long short fund when I'm 40. Guess what? I'm 30 today. I think I know the building blocks of at least how to research, like analyze a company, hopefully determine roughly what it's worth. But I want to do that for not just rich people. And so it's a combination of them wanting to accelerate career growth, because at Titan, like, dude, there's no, like, it's super flat titles here, right? And so like, and we have analysts who have come in, and several analysts who have absolutely crushed it, and they're like effectively now helping manage money. And so it's a place where we're like, we are a fiduciary. I'm on the SEC docs. It's like my ass proverbially is on the line for this. So I take ownership and make final call for things, but like giving people the autonomy to like have a lot of influence how decisions are made, not even just in the investment side, but like the operating side. Like we've had analysts, folks that came from the Yipit Datas of the world or other like buy side shops as well, who are like coming up with great product ideas. So basically if you're someone who's like a little bit not disenfranchised, but like you sort of like, you've seen what the inside baseball looks like on Wall Street, and you're like, life's too short.
Yep.
And you're like, I would love to have more responsibility faster, make an impact for a larger number of people than just like these 10 LPs that are already in 30 other long short funds who are probably just going to get pissed at us if we have one bad year. Like if you want to build long-term amazing fintech products for people that look like us, and hopefully, obviously we think we're going to be a massive business, so hopefully have dramatically more economic upside as an employee of Titan, even in a risk-adjusted fashion, given the size of the market we're operating in, and frankly, the lack of direct competition we see right now. That's a pretty great pitch. It's not for everyone. I would say like for people that are optimizing for cash, near-term cash at any cost, not a good fit. But I think that was like my class, and frankly, my own attitude to some extent 10 years ago, it's not the way today. Like it's kind of funny, like if you go to Penn today, I think the consensus Penn, my graduating year, was like, oh, are you going to Goldman? Are you going to Cerberus? Are you going to JP Morgan? Like now it's like,
that's still
oh, you're going to strategy. Is it still that way? Because I haven't been back in a while, and part of me thinks it's like, oh, so I'm going to strategy and ops at Airbnb. I'm going to be director of finance at Notion. And like, is that the new consensus thing? That's my perception, just because I'm getting hit up from a lot of old classmates who are now making that switch. They're like, hey, I would love to learn more about Titan. And I can tell they're like a little bit over the whole.
Yeah, there's still a lot of like that whole, prestige of like, going to Goldman and, top buy side shop. But I do think there is a little more receptiveness to taking that entrepreneurial leap or going to a startup or even crypto these days. But yeah, I mean, dealing with all these hardos and, our DMs, our Twitter comments, we know it's still pretty much, hey, it's part of the culture, but you do find the people still that want to take this leap and take the risk, and it is changing though.
So Clay, touching on something that Lit just said, crypto. What is your guys' approach to crypto? Have you started any products relating to that?
Yeah, we have. So Titan Crypto, we launched last summer.
This is a good setup. Thanks,
it's a great setup. No, Titan.com/crypto. Check it out. Titan Crypto is basically our version of Flagship for crypto. So we want to identify blue chip. Some are obviously the consensus large blue chip coins, but there's a lot of altcoins in the portfolio too. Goal is to outperform a passive benchmark of market cap weighted Bitcoin, ETH, etc. So what is the S&P equivalent of crypto? Whatever that is, we think crypto is early, nascent enough of a space where if you're in the right communities, you follow the right people and the right data, you can hopefully squeeze out a little bit better return, even net of our fee. Which, by the way, is like by far the cheapest fee in all of crypto. I think we're the cheapest way to own crypto, maybe on planet Earth. You can
Really?
fact check me on that, but it's 1% AUM fee.
Interesting.
And I know it's 2+% to own the S&P effectively of crypto with like a Grayscale or other. So yeah, we have a person here who's I won't call him like degen DeFi, but he has been in the scene for years now, who manages our crypto product. He's outstanding so far. It's done quite well. We're happy with how it's been performing. But yeah, if you're like, similar to Flagship, if you want exposure to crypto, don't have the time, knowledge, resources to figure out which altcoin should I pick, how should I size it, what events, catalysts should I be looking to change my allocation, just hand it off to Titan. We'll do it for you.
So question on that then is, there was that thing with VCs back in the day saying, well, the market for people who wanted, to have actively managed equities wasn't there. But like, is that something you're seeing in crypto where, these, what I call degens as well, like, are they looking for that, saying, hey, like, we know there's a lot of assets out there, we're happy to have you do it, or is there pushback from, people wanting to do it themselves and get burned, or even just make their own money?
Yeah, it's Titan Crypto has been growing like crazy, and I think it's because yes, the problem is huge. I think crypto in particular, like a few things I'd call out. We're so early. The amount of, just look at the nominal price gains and also just the volatility. Like people freak out if their stock portfolio, I would imagine, for every platform is down 5-10% a day. That's like a slow day for crypto. And also it's so early and the fees are so high, there's just a lot of area under the curve, so to speak. There's a lot of people who, and the adoption of crypto is still, single digit percentages? I mean, it's obviously higher for Gen Z millennials, probably well into the 30, 40, 50% own some crypto. Probably they own Bitcoin or they own ETH in a very unsophisticated fashion. But there's still we're very early in the amount of people that have adopted it, the amount of their wallet they've given to it, which I would imagine is like low single digit percent. And I would imagine that's going to march up as like as volatility dampens, as price discovery improves, as fees fall. And there's not much sensitivity to fees because the returns net of fees are still orders of magnitude in some cases higher than what they can earn in stock. So we think it's super early days. It's part of the reason why I think you've seen we've never get asked about Titan pricing or fees. It's just not something that's on the radar. People in crypto are optimizing for upside because they realize net of any even 3-4% fee they may pay to one of these brokerages, like they'll be doing pretty well off. I think it's more about making sure you're in the right coins. That's the biggest thing people come to Titan for. They're like, yeah, Bitcoin, ETH, I've heard of them. I know I should probably have some. But after that, I have no idea what I'm doing. And some of our biggest winners, like Luna, for example, like the Terra coin, like some of our biggest winners have been the non-consensus things, like the things that most people do not own. So speaks to, I think, the value of hopefully active management in crypto.
So when you say altcoins, you mentioned this when you were getting into, the blue chips and then some altcoins, like how far into this altcoin spectrum
are you buying
do you get?
Rocket is what we want to know.
Exactly. Yeah. Okay.
Not quite. It's there's a few filters that are like immediately. So anything that doesn't have any reasonable that we see like near term utility or like decent amount of market cap and liquidity, we sort of or has like any like regulatory or custody risk, we sort of scratch off the list. So like the Doge coins, the Chrome Rockets, etc. Not really fair game. I would say like some of the other stuff that we own that's maybe not too consensus, like the other layer one blockchains are interesting, right? So Avalanche, Solana, Terra, and we just recently bought Cosmos. We own Polygon. So not like the super like long tail degen stuff, even though yes, I'm sure if you sort ranked percentage last 3 year returns, those are going to be like top of the list. But I think we're ultimately optimizing for like sustainable compounded returns. Hopefully coins that are going to be around 5-10 years and can hopefully hold billions of dollars of Titan crypto capital. So some alts, but not too far down the list.
There's some fundamentals behind them. There's real technology being built and user bases, so it makes a lot of sense. And that's kind of where I see things, from a crypto perspective, where again, we're dealing with a lot of these TradFi people that are really crypto skeptic. And, it's like, hey, it's not all Dogecoins, cum rockets, and all these other shit coins out there. It's, there's real things going on there. So I definitely see, where there could be benefit here for that type of investor looking for, fundamental crypto investing.
And so, kind of in looking to the future, where do you see Titan in the next few years? Or what are you guys focusing on? Does the thesis change? Talk to us about that.
Yeah, I'd say walk out of the DeLorean in 10 years. The goal is if you think smart people managing my money, you think Titan. And that is where you have 100% of your wallet to solve that problem. So working backwards, it's like, oh, what do smart people today do with their money? It's probably a good blueprint. Well, we like to use like the Yale endowment analogy. So like RIP, Dave Swenson at Yale Endowment. Like how did he allocate capital? It's like only like 30-ish% is in equities, call it like absolute return, which is basically like market neutral, long short US equities, maybe some macro stuff in there too. The majority of it is alternatives, right? The majority of it is like private equity, venture, private equity / LBO, venture, natural resources like farmland, other real estate, commodities. That's like 0% of wallet for most retail investors.
Yeah.
So like working backwards, if like the goal is I can be 100% allocated like Yale Endowment can with the smartest people, and I feel like I have a direct line of communication into those people. I know every decision they're making and why, and they can communicate me directly to me through a variety of mediums, audio, video, Instagram stories, like that's the goal. So you'll see Titan add more, we'll call it like the menu. Like, what does the menu look like? We only have 4 things on the menu, and it's really 2 food groups. It's like equities and crypto. You're going to see us add more food groups to the menu. Awesome selection, like a la carte selection within each food group, some of which are going to be managed by Titan, some of which are going to be managed by others, not Titan. So it's going to be an interesting transition you'll see this summer. So yeah, working backwards. And obviously, like I do think there'll be a big rebundling. I don't know if I would call it like super app, like with the WeChat of finance in the US, but I do think it's silly to me that there's 20 different investing apps, one for my art, one for my wine, one for my, like why? I know the answer why. It's just a bunch of legacy tech BS on the custodial front, which is people duct taping stuff together for the last 30 years, but that's going to change. So I hope, I won't say Titan's going to be a super app, but I hope that we can be one of the biggest rebundlers of like the best actively managed products. And frankly, like I would love to get everyone into the stuff that I've been excited to get access to as a founder. Like, holy crap, once I like raised a few rounds, people were like, hey, do you want to get into the XYZ round of SpaceX? Do you want to be in the, the Andreessen or the XYZ fund? I'm like, hell yeah, that's awesome. And I'm like the top 0.001% of people that want access to it. And
well,
like,
and
that's
kind of interesting though, because overall you guys are on the forefront of really kind of allowing, unaccredited investors to be able to participate in these markets that historically it's been just accredited investors. And to what you're talking about, over the next 5-10 years or so, it's going to be really interesting to see how the regulation changes. I'm sure you guys will be at the forefront of that, but in this kind of rebundling of these asset classes that, historically people making under 200K haven't had access to.
100%. 100% agree. No.
So lastly, the last question of the day, Clay, which this has been great. And, for our shareholders, a lot of them, probably a majority of them who are listening right now are working in traditional finance. What advice would you give to them about taking a risk to go do something entrepreneurial? Anything you could say, kind of looking back at your 24, 26-year-old self, thinking about making that jump?
I'm trying to think of like some quippy takeaways. Here, let me just rattle off some that come to mind.
Yeah.
One is
we'll
like,
edit, so only the good ones are in anyway.
No. So one is like classic investor advice, but first things first is like protect the downside.
Yeah.
Right. And what I mean by that is like make sure you have like literally enough like savings to like pay the bills, like pay the rent, feed yourself, like have 6, 9, 12 months, whatever it is, of like runway. So that's number one. Because if you don't do that, everything else will be irrational. You'll make irrational decisions. You'll take undue risks. I learned, so I was from a position of privilege in the sense that I had savings built up. I don't want to underweigh how important that was to my ability to like, oh, sure, we'll YOLO for another year, even though no one's giving us money. It was like, yes, because I could pay the bills. So that's number one. So like work a couple of years, whether it's side jobs, hustles, internships, a couple of years out of school. So have enough savings. Number 2 is like figure out what you're ultimately solving for. Like, is it money? That's totally fine. If it's like you're solving for cash, you're probably best off going to like a PE firm. That's probably the surest-fire way to like clip a couple $1,000,000 a year on a long enough timeline, maybe a long timeline. But but if you're optimizing for like impact and ownership and like control, which is not control, but like influence on what I was good at, that maybe behooves you to try operating, like try starting something. Then the third point, which is a pair to that comment, is to like solve a real problem that you yourself have and hopefully have validated in a pretty cheap and fast way. So like do not go the route that we almost went down, which is like smart finance guy thinking of smart sounding businesses ideas. Create a cool deck because you can build a nice liquid looking deck because you worked at Goldman. Like did all of that, none of it mattered. Like no one cared that we worked in finance. No one cared that we had a great deck. Like the idea, the problem, they didn't buy into. We had to have the data to prove that we were solving a big problem. So I would say like protect downside, figuring out what you're optimizing for. My approach was like the Bezos framework of like regret minimization. So I was like, worst case, if this Titan thing or this entrepreneurial thing doesn't work out, I think I'm pretty employable. Maybe I have to go to like a tier 2 or tier 3 buy side shop. Maybe I'm not going to like Tiger Global. Like, come on, I'm gonna get a job. Like, I'm not gonna be on the street. Like, worst case, my parents will have me back in like my childhood bedroom. Right?
Yeah,
like,
exactly.
I will be okay, and not everyone can say that. So again, protect downside. But you know, once you have once you've protected the downside, you've figured out what you're optimizing for. And for me, it was like when I'm 80 years old, I don't want to be like, yeah, I worked at a hedge fund, had a pretty good track record, and that's it. Like, see a planet Earth. That was at least not what I was optimizing for. And by the way, I'm not shitting on people who are doing that. It's totally fine. I just think that the world doesn't need another Wharton undergrad long-short hedge fund analyst. Like, I'll be very honest. So I was like, and there's probably better ones, to be honest. So I was like, well, what the world does need is like, how could I be most useful? And I think democratizing and scaling access to that type of expertise and information is probably one of the best ways I can do it. Hindsight's 20/20. I'm sure if Titan didn't work out or had failed earlier, I'd probably be, but I truly don't think I would have regretted anything. So because I had validated that this is a big problem I was passionate about, I could literally look myself in the mirror every morning and be like, I'm the best person in the world at this. Not like kidding myself. Like if another Wharton guy who worked at Blackstone leaves and starts a Titan competitor today, even knowing he may look exactly the same from a background standpoint, I still think I will beat that person for a bunch of reasons. So that's really important. So man, downside, figure out what you want to optimize for. There's no shortcut for like knowing the ropes. I want to make sure that's like abundantly clear. Like the whole Harvard dropout, start like a Titan for everyone. This would not have worked had I not understood the basics of investing. Knew how to build a 3-statement model, because that's ultimately what shaped the product, which is ultimately what got us product market fit. So like you can't, there's no shortcuts. So if you want to start your own hedge fund or start your own PE firm, I strongly encourage people to like at least learn the basics. And like there's something to be said about like building the network too. Like dude, there's a lot of people I know who like, they worked at like a tier 2 shop, but the person that they worked for loved them and seeded them. And like I know a lot of people who worked at tier 1 shops who couldn't raise money. It didn't matter that they were top bucket. They just weren't good salespeople.
Right.
So a bunch of other nuggets of hopefully somewhat wisdom that I can share, but I would say just like downside protection, optimize for what makes you happiest or you think makes you happiest, and then just try to do it in a really low risk way. So like hack stuff together, build stuff on the side, pay like some dev on Upwork to like build you a prototype or whatever. If you want to go the startup route, if you want to go the finance route, just like optimize for who you're working for first and foremost. Like don't optimize necessarily for brand alone. Because if you're working for an asshole at a top tier brand, you're not going to be happy. It's just a stepping stone. And that's fine. But I would strongly encourage people to like me working with Joe is the best decision I ever made. And like, I definitely did not want to ever work for anyone ever again. Like, so I'm my own boss, and I don't think I'll ever work for someone else. But yeah, man, those are a couple takeaways, I guess.
Awesome.
Amazing.
Those are all really spot on. Yeah.
Thank you so much. That was fantastic.
This has been Big Swinging Decks by Litquidity with your hosts, Lit and Mark Moran. This is a Red Rock Music podcast. Our executive producer is Red Yoakum. Our associate producer is Emma Martins. For more, follow us on Instagram at Litquidity and at It's Mark Moran, or visit the official website liquidity.co. So tune in weekly to your managing director secretary's favorite podcast, available wherever you listen to podcasts.